Good evening, everyone, and thank you very much for joining us tonight. There's a few of us online running this session. We've got Kieran O'Callaghan who's joining us tonight. Kieran's a funds manager, has worked for Macquarie Bank, Dennings Price, and has used options as a trader, but also very much an investment manager and funds manager. So we're going to have a sort of an investment bent on tonight and go through some examples or an example of where options can be used in a period of high volatility or fear in the market. So Kieran will come on in the latter part of the session, so please make sure you hang around for that. Ivan Churilov, who is the designer of the options trading game and has built the technology behind it, is also here, and Tim has joined myself, Patrick Nelson, joined by Tim from the Reach trading team as well. So we're here. We're going to run through and have a little bit of a look at the leaderboard of the game so far, and then I've got a couple of things to look at. There's a couple of trades approaching breakout, so we might go and have a look at those trades. And then certainly the session is designed so that if you've got questions, you can ask them, and we're happy to go into any of the technology or any of the charts or anything you need us to go into and answer any questions that you have. So as far as the leaderboard goes, Ivan, are you with us?
I am.
You are. All right. So, well, look who is right up the top there, Tim. Congratulations, Tim. You were leading from the front last game as well.
Yeah, that's right. The trick is to try to hold it this time. So I'm moving my positions around quite a bit more often than last time.
Yeah. So
you're doing all right, mate.
Yeah, it's not bad.
Yeah. So we've had a really good participation in this game. So good result. We've got a bit of representation from the Reach team in the top 10. I'm happy to see that.
And trade floor as well.
Yeah, and trade floor as well. But we're not allowed to win, so don't worry about that. We're not allowed to share in the prizes. But otherwise, some good trades there, and some people have been doing very well. So we'd encourage you to get going. And the good thing about the game is that, because you're not trading with real money, you can take a few more risks, which keeps you relevant all the way to the very end. And also the others playing the game will be equally taking a couple of extra risks as well. So we have seen people go from hero to zero pretty quickly, and vice versa as well. But, the game has been put together to give you an opportunity to play around in the market and test lots of different strategies and practice using some more advanced technology. All right. Now, Ivan, were there any trades that you wanted to go and have a look at or discuss?
I will, but do you want to give a general advice warning since you do it all so well?
Oh, yeah, absolutely. So let me just run across here. Any advice contained in this webcast is general only. It doesn't take into consideration your personal circumstances, and you need to decide for yourself whether it is appropriate for you. Past returns are not an accurate indicator of future returns.
Bang, bang. So I'm going to look at the trades from end of last week as they sort of settled over the weekend, because that allows us to define the weekly winner, and ultimately then Patrick can go on and award a weekly prize. So we've had, this has been by far the best result that we've had from our internal guys. Belinda is one of our developers. Blake sits right next to Tim on that leaderboard. We've also got Brock, who is the co-founder of Trade Floor. We literally, out of the top 5 as we sit now, is this 3 of us somewhere. What that ultimately shows is that because this is the second or third time that they've played, they're getting consistently better at doing it. Now, having said that, Tim is still working with us. He isn't retiring on all of his winnings. And what we're going to be talking about over the next 3 weeks on these Tuesdays slot is really how do you take that from playing a fun simulated environment into actually trading for real. So having said that, a couple of the trades that are winning, we go back to this every single game. This is what the 3rd year we're running this now, and we're up to 4 games a year. So typically the trades that win are the bought calls, the bought puts, the highly leveraged trades, the trades that ultimately are probably not the right trades in a long-term portfolio unless you're using it for other purposes like hedging. Typically the insurance type products. But having said that, the winner of the week that is not us was William, who is 6, I think, at the moment. He's just dropped off a little bit. He bought, Patrick, I don't know if you want to bring up a chart, but CBA was a trade that he did. He bought some October puts on the 1st of October, which was the second day of the game. At 80, it was 81 puts, and he still got them. So that was the best trade of that week. So good timing.
Yeah, very good timing. How big a position did he take?
370 lots, and it was at the money at that point in time. So I think it was roughly the full 50K. So yeah, more than double his money. And I mean, if you look at the move, what are we? I can't see. It's about 70. It's about almost just below 80 right now, 79.60 or something, right? It's not exactly a massive move, right? Like you do that with equities, you're not really going to get a whole heap. But yeah, it's amazing with options in a big enough position how big of a difference it can make. Other big trades, Patrick put on a 60 December put on the STW. That more than doubled 2nd of October to the 4th of October over that big sell-off. Belinda did a similar trade, who works with us, 67.25 October puts. She bought 50 of those, so it's a pretty chunky position. Actually, obviously came off quite significantly on the first day of the game, 30th of the 9th, sold out on the 3rd of October. Oh, sorry, or bought back sold the puts on the 3rd of October. Tim, you've done a lot of trades, and while you're there, maybe talk a little bit. The things that I was interested in, I was looking through your trades, and firstly, one of the questions that people generally have when they're playing the game finishes in October. You've done a lot of November expiry trades.
Yeah.
Do you want to talk a little bit about the rationale behind that, and do you want to talk a little bit about some of your smaller trades?
Yeah, sure. So mostly just trying to get a feel for the markets. Was looking for, first of all, I expected a market fall to occur when the interest rate came through, the interest rate change, the cash rate change. And I wasn't really sure when it would happen. I was hoping it would be quite quick. It turned out to be quite quick, so I was quite lucky. But if it was going to be something that was going to take a bit of time, it may not have happened this month, basically. So I was looking to have a bit more expiry time on those trades, so if it doesn't go the way I want it to, I can get out of it and not have theta decay wipe out my whole portfolio. With the second round of options that I put through, I did go for something a little bit more risky and only have an October expiry on those once I closed out all those original positions. So the original positions were shorting, it was NAB, Westpac and Commonwealth Bank, just by buying straight puts and a little bit out of the money. And what I've done as the next round, I've just bought calls with the expiry in October on, I believe it was Woodside, Wesfarmers, Woolworths,
Woolies,
and Santos as well, just purely because of the way that the stocks have been trading in a range recently, and they have been very responsive to support and resistant lines throughout basically since December this year.
Last options game, you did the same thing. So you were effectively using puts and calls to trade around stock ranges, which was quite interesting. So you leverage up on those positions. Slightly out of the money means you can put more size on, correct?
Yeah, that's right. So in the last game, I went quite out of the money with Woodside Petroleum, and over the course of a couple of weeks, I had many contracts, and they just ended up coming very, very deeply into the money. So it was a very profitable position.
Yeah, and that had a pretty good slide as well. So
yeah, it was great.
Yeah, yeah. I remember you played the long side and the short side, so it's pretty good. Blake, who sits next to you, chucked on some extra calls, so he actually made money on the market going up. So just a reminder for all of you that are listening, you buy calls when you expect the market to go up, you buy puts when you expect the market to go down, or vice versa. So he bought some extra calls more recently on the 3rd of October, so you got a bit of that bounce. What's the internet meme these days? BTFD by the dip, and then with another word in there, and then he also put in some wow calls as well on the 3rd, added on the 7th. So both of those trades have done pretty well for him.
He loves Woolies.
Woolies, yeah. So you did Woolies as well, I think, right?
Yeah, that's right. I did it as a bit of a punt. I saw a bit of potential there. It was more as a joke to just say to Blake, I'm calling Woolworths as well, just to go along for the ride. But yeah, it worked out quite well.
Yeah, this is why all of you guys that are listening in, you guys should be setting up leagues and playing with your friends, because you just get so much more out of it while you're playing for bragging rights as well as potential prize at the end of it. So yeah,
is getting pretty fierce.
Yeah. I know Patrick's got a problem with both Tim and Blake because their productivity is dropping off because they're too busy playing the game.
This is true.
Call volumes are dropping. Yeah.
Yeah. And
all right.
there was just one more, just really quickly. So another one that was quite good. Michael put in 2850 ANZ November puts, added to that position. So he did that on the 1st of October, added on the 4th of October, sold some on the 7th, and scaled out completely today. So that was quite impressive as well, watching the use of scaling. Overall, the interesting thing is as a group collectively, this is probably the first time from memory that I'm seeing that we're actually, as a collective, we're all up. So adding up everyone, we're up about 2% on our portfolios. But as a proportion of clients that are actually up, it's 38% of people that are playing the game. So there's still a hell of a lot of potential to catch up to the guys, especially since most of the top, as Patrick said, we can't win. So so the top 5, they're all up over 100%. Tim's up over 300%. Which I can just see him smirking at that now. But it's and a little giggle in the background. Yeah, I bet you are. But
hey, there's a couple of questions,
yep.
Ivan. Paul's asked, why use STW over XJO for an options trade?
Good question. In terms of the specific usage, I don't know. That really was something that Patrick decided to use, not the Patrick on the phone, the Patrick that traded it. Having said that, in the real market, the only reason you'd really use STW is if you want to own the ETF. So you don't want to have the cash settlement and you want to go in and have that exposure to the ETF across the whole 200 and use it as collateral against potentially specific cover against your STW call options that you sell. That's pretty much the only way that I would imagine.
Right. Paul, I guess your question is coming from, just for other people's benefit who might not have the same level of experience. The STW can obviously, well, not obviously, you can sell for STW stock, so you can write calls over your STW and get exercised and have your STW taken away, or you could sell a put and end up owning STW, but they're not as liquid as XJO. So if you're trading, you would be, I can't think of a scenario where you'd be trading where you wouldn't reach for XJO over STW.
Just on that, the biggest reason why I would always steer towards XJOs, literally unless you want to have that as part of your ownership of 200 stocks in your portfolio that you use collateral, XJO is cash settled. Which means that if things go wrong, you don't have to face assignment. It literally, whatever the value is at the end of the month will be what will be transacted across your account. That's it.
Okay. Martin has asked, is anyone using weekly options in the game?
Yeah, there's a few people using them. Most people stick to monthlies, especially because it's a little bit harder in the platform to find the weeklies. And the reason for that is because this is the same platform that we use for the real market as well, which is called the implied volatility platform. The main reason for that is there's not the same amount of market makers in the weeklies as there are in the monthlies. So generally weeklies are probably used by people that just are a little bit more experienced with options, just so that they don't get stuck in the trades ultimately. That's literally the big differentiator.
All right, beautiful. Ivan, is there anything else you wanted to go through game related?
No, I don't think so. I think that pretty much covers it. William will get the weekly prize, and hopefully some of you can put out a really good result over this week.
Yeah, so tomorrow at midday, we will be running the trade group discussion. It'd be interesting to see how the market goes overnight. And if we've got a bullish run, we'll be starting to look at some breakout trades, right? So there are two trades which are lining up. I'll go and have a chat about those in a moment. But for game players, you'll notice that you've got stock screener, options cookbook, and you've got trading scans, right? And trading scans look at, I guess, indicators that we've reviewed to put trading opportunities forward, right? And all of these have been quant tested, and we've done a lot of research looking at hundreds and thousands of data points to establish that we believe there is a significant edge if certain things line up. And some of those things are built into scanners, which is scan the market, and if they line up, they present a trade for us. Now, at the moment in trading scans for directional breakout trades, there are, we can see there are no trades that are active, but if you watch my mouse, you can see on the every stock, all the main stocks that are listed down here, you'll see lit long and iron condor, and you can see lit long, Coles is approaching, James Hardy is lit long approaching as well. All right, so it's just identifying, hey, there's not a trade there now that meets the rules, but there could shortly be so keep an eye out for it, or you might want to be aware of that. So we go into Coles. So I'll just say that when we're doing a lit long trade, and I'll go through the rules for this in a moment, when we're doing a lit long, we're trading a breakout. When we're trading a breakout, it's what we consider a significant situation, and we're at a significant pivot point. And when it breaks out, history has told us through all of the back testing that we've done that the most likely scenario is for it to continue to break out in the direction that it broke out, right? Except that when we're wrong, it fakes out and we're significantly wrong, right? So it's either going to go up significantly or down significantly is our hypothesis when we enter into the position, right? So when we set the trade up, we're setting the trade up with a strategy. It's an at-the-money bull-put spread. And by moving into that lit long at-the-money bull-put spread, it allows us to reverse our trade from being bullish to bearish pretty seamlessly if certain things happen, right? So I'll go through the rules with you in a moment, but what you notice if you follow the trading scans each day, when a scan actually comes up, so let's say market's up, Coles is up tomorrow, and it breaks through and it's in a breakout trade, you'll see that this will go from yellow to green. And if you click on it, it'll actually pre-publish an at-the-money bull-put spread with the right time and right strikes and everything set up for you. And so if you want to trade those trades, you can use the platform to go and play around with it. All right? And you can post some of those trades up. So we're looking at Coles. So I'll just quickly run through the rules very, very quickly, and then we'll come back to this trade. And all right, so with a breakout on the upside, we're asking ourselves 5 questions. The first one is the share price above a major 52-week high. All right, so we'd be, at this point in time, we can see that had actually occurred. That was a 52-week high breaking, and so that was the first indicator of a breakout. All right, is the 50-day moving average, if the 50-day moving average above the 200-day moving average, so we can see this golden cross has occurred here. and that the shorter-term moving average had crossed over, indicating a bullish trend by itself, not enough for us to want to trade it, but it's there. It's giving us an idea of the trend. Is the share price above the 50-day moving average? And the share price is well above there. Is the 50-day moving average trending up? Yes, it is. And is the ADX above 20? You can't see it on this chart, but that is the other thing that we'd be checking, and that is just telling us that we believe that the trend is present, right? So they're the questions that we'd be asking ourselves, and tomorrow what we'll be doing with Coles is you'll see that if this trades above this 52-week high, then it's a breakout. Now, my shorter-term moving average is above my longer-term moving average. The golden cross occurred some time ago. Trend is up. You can see the 50-day moving average is trending up, and that the share price is above that level. So once it moves through the 52-week high, that will be a bullish breakout, and we'd be looking at putting an at-the-money bull put spread in place. And with an at-the-money bull put spread, it is a position where we've got capped upside, but we have got significant upside. So generally, if we say you're risking, you're putting $2,000 into the trade initially, you'd be expecting that you could make sort of $3,000 or $4,000 be kind of what you would be aiming for with the particular trade. So on the upside, you've got plenty, 200% return plus that you would be looking at. And when we trade these trades, we go with the trend and we stay in the position. So we're not looking at making a 20 or 30% profit. We want 100%, 200% type profit when we move into these positions, and we're happy to go into the trade and stay in the trade. And if it's moving in our direction, we've got time working on our side. Equally, if we decide that we want to go bearish, and the rules for us to go bearish are pretty simple. It breaks the 50-day moving average, and in a fairly significant fashion, i.e. it doesn't just dip a toe and go back up, but it breaks through that level. Then we'll switch and we'll buy back our sold leg, and we'll be in a straight put, right? And so if it's not a breakout, it's a fake out, and usually if that continues, there'll be some significant move in that direction. So they're the basic rules for trading that particular strategy. Again, it's a break of a significant level, and all the other factors line up, and then we move into the trade. We want to stay in the trade and stay with it for an extended period of time, and then if it reverses and breaks that, we'll switch from a bullish view to a bearish view and trade that directional view as well. So at the moment, we've got Coles, and the other is James Hardie, as you can see here as well. Golden cross, $25 level's the level we're looking to break, that 52-week high, and share price is trading above the 50-day moving average. 58-day moving average is trending up, and that'll be another one that we'll be keeping an eye out for tomorrow. So if you want to come along to the trade group discussion tomorrow, we'll be going through and just looking at whatever stocks anyone wants us to look at and having a technical view on those. We'll be looking at some trades if anything's lined up, and going through that and probably price those trades up as well, and have a look at some payoff diagrams. Right. So and both of these trades have been trades that have been breaking up. So it's not the first time that James Hardie or Coles have identified trades. We can see back here in August, early August, we broke the 52-week high, and that was been a great trade. It's probably presented itself another time, and has continued to be a good trade. And as it breaks up, we'd still be looking at it, and exactly the same if we look at Coles. Sorry, press the wrong button. Over 1 year, we had it has happened a number of times. We had the more recent breakup here, and it's continued to trade up. It's pulled off a bit recently, but it's back to that upward trend. So they've both been trades that have been, as many others have been producing quite a few signals on the upside. All right. Anyway, so that's pretty much everything that I wanted to cover, and we've now got Kieran, who is going to talk through, I guess as a professional, as a funds manager and a trader of note. Kieran, I might hand over to yourself now to talk through this. I mean, maybe by way of introduction, just a little bit on your background.
Oh, thanks, Pat. I'd rather talk about the game. I think I want to play the game. The game looks like fun.
Hang on, you're not playing at the moment? What is this?
Well, I didn't think I was allowed to, but now I'm going to log in tomorrow.
You just can't win, Kieran.
Oh,
well, you can win, but you can't get the reward.
I won't get the reward. No worries. Well, I'll just have the personal achievement. So thanks very much, guys. Thanks very much, guys. Just as by way of an introduction to myself, I joined investment markets in 1993, where I started on the Sydney Futures Exchange. I traded the share price index futures, bank bill futures, bond futures, wool futures, wheat futures, all those sorts of things right through the 90s. I was a gold trader, options, silver, forwards, FX, and then I joined equity markets in 2001. So I've been involved with equity markets for the last 18 years, specifically as an exchange traded option and OTC option market maker, price taker, risk manager. So all of those structures and strategies and prices, I can see those and they all look pretty good to me. So from my perspective, just talking to the last 5 years that I spent at Denning Price, managing risk over a large buy right equity income fund, which at its peak was around 720 million bucks. And then it closed down in July this year due to various reasons, which we don't need to go into. However, the experiences that we got from running these funds, specifically in the last sort of 3 years where I was lead portfolio manager, were varied, and we employed different strategies lately as opposed to earlier in the life of the fund. And although I'm talking about 2016, probably it's very, very relevant today, specifically or especially this week, given the trade talks in China. And the fact that they've been looming for a month, then we've seen some really solid price action globally and domestically leading up to this. And then you have a little hiccup last week where it all sorts of gets a little bit shaky ahead of that. So if I talk to both of those, maybe we can just draw links, draw a link between those two. But in 2016, in March, we sort of looked at Brexit coming up, looming, indecision, although at the time it wasn't thought that it was in any way, shape or form a chance of happening. However, that's not for the equity fund manager to really decide to take a bet on that, so we just decided that given we were heading into year end, it was necessary for us to protect some of the performance that we generated throughout 16. And so we decided upon building a low-cost structure, selling nearer dated out-of-money calls and buying out-of-the-money longer dated put options, usually in the ratio of around 1 to 2. So we were selling 1 call and buying 2 puts. And really importantly there's a couple of important pieces around the costs, around the exposure that we were trying to deliver. But more importantly, what we figured out was what we wanted to do with respect to our strategy. So in the lead up to events, in the lead up to Brexit, we anticipated that there may be some uncertainty and some turbulence. And I like to use the term opportunity with turbulence because I think those two often go hand in hand. So leading into Brexit, we built this position. On the day of Brexit, we had some violent price action and we were able to monetize the calls by buying those back. And when the puts had sharply increased in value, we were able to then sell some of those out and roll them down to increase our protection for November, which was the US presidential election, which had been part of our strategy. And we were also able to crystallise some gains in terms of just selling some of the puts for profit so that we could live to trade another day. But more importantly, for those people that are new to the options trading game, by selling half of the puts, what that enabled us to do was to maintain some exposure. So if you like, when you buy a put, you're creating a short exposure. Similarly, when you sell that put, you are closing that short exposure out, and in effect, you're buying the market. So as a long equity fund, it was necessary that we maintain our exposure according to the mandate on that day. And it was getting too light. So we needed to sell some of the puts to generate some profit, and also to take our exposure higher. Now, that seems like a good opportunity and a good decision and a good place to be in, and that was actually the plan. So that's, if you just roll forward one chart, the one screen, then we can see, I've just described everything that happened there. But the most important thing that we really did on that day was that we stuck to it. We had our plan. We'd anticipated certain outcomes that may not happen. But then really what we did was to drive in there and actually do what we said we were going to do. Now, as a fund manager, that's pretty important, because that gives your unit holders and investors some confidence in your method and your investment strategy. Now, as a fund manager, there's not really much difference there to a person who's investing or trading or playing the game. The hardest thing to do when you're trying to make decisions around taking profit or cutting loss is that you haven't actually thought about it until it actually gets there. And probably the best thing that you can do is to anticipate when it gets there, if it gets there, what will I do? And the only way that you can do that is by having clarity around what you're trying to achieve to begin with. So if we circle back, so we were trying to achieve some protection in the event of a sell-off. And when that sell-off occurred, what we wanted to do was to monetize some gains, to put some income into the book, and to also be able to roll out the protection to November, so that if there was any surprises from the US presidential election, we would be prepared for those, and we would have funded those, so that we wouldn't have had to be spending additional money to protect the book. So it's sort of an active portfolio protection strategy is really sort of what we were aiming to achieve there. Now, the outcome of what happened was that the Brexit day was a very good day for the fund, and typically on a day like Brexit, everything goes down, and those are traditionally bad days for funds that are trying to either be long short or hold options or whatever it might be, because it's what's called a correlation 1 event. The ensuing rallies and uncertainty around the US election was really a help for the fund, because it kept a little bit of bid in the volatility, and it also meant that there was still a continued bit of uncertainty. The Trump election was almost an identical outcome for the book, and we made similar decisions on the day to monetize calls and also to roll puts down and out. That actually then ended up being a bit of a drag on performance going past November, as the rally out of that rally out in the S&P and the ensuing sell-off and volatility proved to be very, very savage, and we lost a little bit of performance there. In the end, I think that was probably more around the fact that we weren't active enough in managing the position. So again, if we go back, we had clarity around the structure, we had clarity around the investment idea and the strategy. We were just maybe a little bit slow or not active enough in managing it. If I just quickly segue then into the China trade talks, these trade talks pose as a very similar event in the sense of what's happened in the last month. Trump's tweet saying that they would have this meeting this month was met very well by the markets, and we saw a savage rally up through the 2950 level in the S&P, and everything globally sort of went with it on the back of that, and the fact that they thought that they will get something, or they will get a good outcome from these meetings. So as traders leading into this, you can build a very, very similar structure to this, could prepare for an outcome like a Brexit or a Trump election. Similarly, you may think that it could be a surprise to the upside, and you could switch that around. But that's probably a talk for another day. I'm happy to take any questions or comments.
Absolutely. Actually. Thanks, Kieran. That was great. When you're running your portfolio, how often are you using these types of strategies? Is it event driven? Are you having a technical view? How often is and what are the sort of drivers for you to start to think about getting these positions set?
Well, that's a great question, and it's lovely as an options trader. One of the real benefits that you have, because the real key to an option is time, and that's really everything that really drives the value specifically. Then what you really want to do is use that as your decision maker and driver. So specifically, is there an event coming up? And in which case, what is it? What do we think is going to happen? And can we use options either before that or after that? So if you think there may be a big move, then you can maybe, if you think there's going to be a big move, for example, like Brexit, you can sell options ahead of that meeting because you think it's going to be quiet and volatility will be low, and use that to fund longer dated surprise. So we specifically use time as a real key, and we try and pinpoint. Sometimes you try and pinpoint the times. Other times you're happy to as Tim was talking about before, to take a bit of a longer view, because he wasn't quite sure it would happen straight away in October after the RBA meeting. So he used November options. So it was quite clever. The other indicators that we really used more often than not were the actual implied volatility versus historical volatility levels, and really try and read those into, like you've done with your lit strategy, technical indicators as opposed to price. When you're not a fundamental stock analyst, then you need to be, you still have to have a view about what you think is going to happen. Now that view might be you don't know what's going to happen and it's going to go up or down, which I haven't talked about before. Or it may be that you feel that the market is going down, or you may feel that the market's going up. Either way, once you've decided what that is, what you're trying to achieve, then you can choose the structure that best talks to that investment idea and delivers you the best profile with the least amount of risk. Now, when I say least amount of risk, that sounds like you don't want any risk, but the fact is you want risk, because without risk you can't make money. But the question is are you giving away too much risk for the reward that you're going to get? And that's how, once you start investigating those decisions, so in other words, the choices, then that really can drive the structure. And possibly the last thing that I would talk about, which might be worthwhile for the players of the games and any option people, is dividends and reporting. So reporting is time, and dividends, specifically with single stock options, are a real indicator of choice for me. They're the one things that I love to really look at with respect to when do they occur and how much are they going to be, and then looking at what the market makers and what the markets think about those things. But that's getting a bit technical. However, it's a very important part of that option sort of strategies, to understand that you've got different exposures to dividends over time, because they're the only options. FX, gold, all those other ones, they all have continuous streams, whereas dividends have that specific point in time when it happens.
And it makes pricing up options significantly harder as well.
Impossible. Yeah.
Well, it's not impossible.
Not impossible, but really, really difficult. Sorry, that was
the crazy folks at Tradefloor figured it out. There's a couple of questions for you that the guys will ask you in a second, but I've got a question for you. Why don't more fund managers use options in their portfolios? I mean, clearly there's so many benefits of using them, even if it's just for buying stock instead of limit orders. Why do you think that, there's only a handful of people that use it?
I think there's a couple of things. The funds that have originated out of, say, the 2000s probably were born in a time where the option derivatives, as it were, it was the dirty word, the D word, and so that was a difficult product for them to market and to sell. And also it was a very difficult product for the analysts, gatekeepers to understand. And so therefore it made it very hard to get people to invest. I think that was part of the reason. And also then designing mandates around with people designing mandates that could really have a rigorous risk structure or risk framework. I don't think they'd really seen that often. I think, we spoke the other day about like a limit down framework, and I've seen a couple of the option ideas. So that limit down framework or limit up framework, I don't think was a concept that people really understood strongly enough to use on an options basis, and therefore they just found it too hard. I'm surprised that they don't, because as I've sort of alluded to in the past, that if you're not using all of the assets and tools in the market that's available to you, then you're leaving the performance on the table for someone else. And when rates are going very, very low, returns get compressed, and that performance becomes more relevant. Every sort of basis point becomes very, very precious.
What's your favourite expression, Patrick? That when all you've got is a hammer, everything starts looking like a nail.
Yeah,
that's right. I like
Yeah.
that. Very good, very good expression.
Yeah.
I've only
Now,
heard
I've
it
got
a couple of
questions.
times.
I've got a couple of questions for you, Kieran. There's a few people have asked questions. Now,
That's
Paul has asked, does the one near-term call pay for the two far-term puts because the theta is higher on calls and lower on puts? Would skew make this challenging to set up? Maybe you could just talk to that setup a little bit more.
Okay, so the first part of the question, the theta on calls and theta on puts, I'm not quite sure whether, that's pretty specific as around strike. I was selling a higher delta call than I was buying lower delta puts. And also sometime, so in other words, I was probably selling a 35 to 30 to 40 delta call and buying sort of 20 to 25 delta puts. And the drift, it gets more expensive now that rates aren't as high, but the drift, that forward price can tend to give you an artificial sort of skew in the sense of the premium you're receiving for the call. But overall, like, it still looks, if the market's say at 65.50 and you're selling like a 6,700 call for 90 points and you're buying that for, you're selling a 2-month, 6,700 call for 90 points and you're buying the 3-month 62.50 puts for sort of 30. Sorry, let's say again, say 45.50. Then you're sort of thereabouts. I was always paying a little bit to get a little bit on, because I just sort of feel that you're sort of in a better position once you've paid a little bit to get that on. You sort of get a little bit closer with the puts, which is always, as a manager or a risk manager, you just feel a little bit more comfortable when you've got that position, because you can lean into it a little bit more if you get an event like last week. You sort of, if you do get that pullback, and these pullbacks tend to get shorter and sharper every time, then you can sort of lean into it and sort of sell some out pretty quickly to make the cost less overall. It facilitates
so David,
more active.
Just on that, Kieran, David's asked the question, were the sold calls over individual long equities?
No, over index. I did use that strategy in single stocks as well.
Okay.
Just quickly, just to bump in, for anyone whose head is about to explode with all these new terms, just really quickly, effectively what Kieran is talking about is selling something of much higher likelihood of getting or being in the money. So the puts are there as protection and the call is there for revenue streams. So these are some of the things that once you watch all of the videos and the educational portal and you go through the 10 button, you'll have a much better understanding of those concepts. They're not, it's just, once you talk options for a certain amount of time, and I'm more than guilty of this, then you start, it's just making the assumption that everyone is on the same level. And in terms of this, if you freak out, don't worry. As you start grasping the concepts of options just through sheer practice, you'll start noticing some of these things on the screen. They're all there for a reason. It's not there to confuse you. And you'll start understanding, especially, these type of ratio trades are very common with traders, but they're a little bit more advanced. It's stuff that you'll start doing in some time, in some stage.
Ivan, can I just hold you up there for one sec? So for people who, if you're out there playing the game at the moment, it's a great opportunity to test lots of different strategies, and you can do things like that aren't going to win you the game, like insure your portfolio and sell some calls and do those sorts of strategies. So most people end up going pretty aggressively. But if you take a trial to use the platform and trade with Reach Trading, when you take that trial, we put 50,000 fictitious dollars into your account. So beyond the game, and even while you're playing the game, if you want to open up a trading account with us, and there's lots of great reasons to do so, including the fact that you can do all the spread trades online if you're trading with us, which is not something you can do anywhere else. Our brokerage rates are cheaper than anywhere else for options, and we specialise in options, and there's a lot of support behind the scenes for you. You've got your own personal trainer. We do online sessions each week. You've got all the stock scanning tools and all the other different bits and pieces that have been built into this. Basically a service specifically for options traders or investors that use options within their portfolio. It's all set up for you. So if you'd like to take a trial or open an account, just type in yes and we'll coordinate getting all the information to you that you need. So type in yes and we'll get that across. It's also there that the trial that you can use outside of the game at your leisure at any point in time. You can trade with an account with real money in it, at the same time practice trade the strategies we're talking about today and the like. All right, so just get the yes into the chat box. We'll get you set up. I just want to reflect on this slide here that Kieran's put up, and Kieran spoke the other day and actually took some notes from his presentation, and he slightly reworded the same thing. But this is so true. When you're going to do an options trade, or like Kieran, you're using as an investment manager options, first thing is, what are you trying to achieve? Being super clear on that. When we're doing the lit breakout trades, what are we trying to achieve? Well, we're trying to take advantage of a breakout on the upside. All right. Second question, what will you do when it gets there? Right. Do you take your profit? Are you going to be in the trade for a period of time? You have to consider exactly how you're going to behave once you're in the trade, when the different things, and what other choices you're going to have. What are you going to have to make? Is it going to go the way you want it? Is it going to go more than you expected? Is it going to go against you? All these things you have to consider and you have to be clear on before you get into the trade. So I think really valid, some really valid points there. You'll hear it from traders and investment managers and the like, or if you're not hearing it from, you should be hearing it from them. Just getting super crystal clear on what the objectives are, and how you understand it, and once you're in the position, how you review why you're in it and what information, especially if there are others involved in the process as well. Super important to get crystal clear on these things. Now, just having a look at. Can
I just ask you a quick question?
Yep.
Sorry. Can you give Kish an extra 7 days just for the enthusiasm? I love it.
Sure. Yeah. All right. All right. So do you ever get straight collars on stock? Do you ever use long-term calls as a substitute for stock, Kieran?
Collars on stock definitely was a strategy I really quite like to do, often because when you've got, either way as well, because generally when you're long a call, in a buy right portfolio, if you've bought a call as the stock rallies, it gives you an opportunity to crystallize those gains. You can either elect to exercise the call at expiry and receive stock, or you can sell another call. An old friend of mine told me once that the best hedge for an option is another option. So, if you're long that call, you can sell out of the call. That's nice. And that will give you the opportunity to buy back that call if the market falls away, to trade it around. Longer dated calls as a replacement against stock, we used low exercise price options and 11-cent options, which a bit like forwards or futures. So I won't go into those. I tend to shy away from those. I tended to shy away from those in the fund because primarily for the reason that buying longer dated calls exposed you to being long volatility, or what you would call vega, and in the environment that we're in, that wasn't really. I didn't have the investment ability to be able to argue the case of that position that the fund wanted to take. And also, it generates a poor dividend position from the perspective of an income fund who's looking to grow their dividends and whatever. So really often you want to hold the stock so that you're receiving dividends. And then there's a few other reasons which there was a few other reasons like exercise difficulties and stuff like that you didn't really want to put yourself in front of, because as opposed to trading, there's funds management as well, so you do have to manage the income position as opposed to the profit position. Does that help?
Yeah, beautiful. And an excellent thank you from Paul. Now, Mark has asked, generally, how far out are your long-dated out-of-the-money puts? Do you see liquidity start to drop off at a certain expiry? And are any of your trades OTC or are they all exchange traded?
So I'll do the ETO piece first. ETOs primarily. I just love ETOs. There's clarity around the position. You can see them. They're marked, and you don't have the issues of novation, and also that you're not beholden to the man. Specifically if you talk to an event like say a Brexit or a Trump, the last thing you want to have is to be owning puts and then to be calling one specific guy saying, can you make me a price? And he's busy, or he can't provide you with liquidity, or he's going to make you a
or he's not there to pick up the phone.
Yeah, or he's just off, panicking downstairs having a smoke. So I much prefer the ETOs. I love the transparency of them. Even with your game, I can see them there and I can see the codes, and so it's lovely. So it's accurate. So that was ETOs first. What was the other question? The bit about
how far out are your long dated out of the money puts?
Yeah, 3 to 6 months is really neat, especially in XJOs. Single stocks, a couple of reporting periods, depending upon top 20 was pretty easy. Once you get sort of out past the top 20 stocks, it tends to become a bit more, a bit by appointment. But again, specifically as an equity income fund manager, I was not as price sensitive around the volatility, given that I generally wasn't exchanging delta. So I was more using the options to express my view as opposed to express my view about volatility, if that makes sense, in the sense of you can trade options, if you buy a put and a call at the same strike and it's at the money, then really all you're doing is you're expressing your view that you think volatility is going higher. There is no exposure per se. And similarly, if you sell it, you think it's going lower. But for me, I was always happy to be, I was long stock. I was traditionally selling calls away to drive that exposure lower, and then I was managing the risk. So that was really the nuts and bolts of the book. And a lot of the risk management across the portfolio was done in the XJO. So it was like often you could be short single stock calls and long index puts as the real risk strategy, which in general tends to work quite well, because you get that, as I talked about before, the correlation one event where everything goes down in a straight line, and your index helps with that.
Just in terms of liquidity.
And the last piece was liquidity. Liquidity in Australian ETOs is fine, from my experience. It's not as deep as it was in 2007, but nothing is. And it's changed, but there's still plenty of market makers there that are happy to make prices, and they're quite tight, I think.
And they've just gotten a lot better again with the recent reviews. Guys like UBS, for example, they're not, you look at the market making schedule, they're not on every single stock, but they're actually trading every stock. And there's a couple of places there that haven't updated. There's a couple of new market makers that have come in, a few more coming in. So especially starting from the XJ downwards, like anything within 12 months, you're okay on, with exclusion. As you said, outside of the top 20, it starts getting a little bit more difficult for retail punters, for the guys that are trading on our platforms. Outside of the top 40, 50 stocks is where it starts getting a bit more difficult. And for things like iron condors, you want to get something directional on, you're going to get it on anything. Even James Hardy, we were talking before, like you're getting it at midpoint, so it's not bad.
Amazing.
So I mean, clearly, if you're if you're trying to get an iron condor or so on James Hardy, and you're doing it for the notional value of the whole day's volume, that's hard. But the rest is not so bad.
Absolutely. All right, Kieran, thank you very much. That was fantastic and really insightful. So I'm sure a lot of people got a lot out of that. So thank you on behalf of everyone in attendance today for giving us that presentation and update. Definitely welcome you back to future sessions in future games. Next week we've got Graham O'Brien from the ASX, the head of derivatives, joining us. So Graham is, very knowledgeable man, can answer any question you throw at him, generally speaking, about the markets and the like, and he'll be giving us an update on what the ASX is seeing, what sort of strategies they're seeing commonly traded, what's the most popular things out there at the moment, and what else he'll be talking about, I'm not entirely sure. He hasn't told me yet, but he's always good value. So we'll be back tomorrow at midday doing the trade group discussion. So we'll be in the market live, having a look at seeing what's presenting itself. There haven't been a lot of iron condors, breakout trades. There could be a couple of lining up, but we're happy to go through technically, look at any stocks, price up any trades. And, if you've got questions, you want to have a chat with Tim, please do so. There's obviously the chat function on the platform. You can send messages through to us and get responses that way as well. Call the office, do whatever you need to do to get you to get an understanding of what you need to move your trading forward. If you've requested, as quite a few people did, a trial of the platform beyond the game, or to set up an account, just type in yes, and we'll get that sorted out for you as well. Hope you're enjoying the game. Hope you're enjoying the sessions. Ivan, anything else from you?
No, just when you're typing in yes, have Kish's enthusiasm and you'll get something extra.
Very good. Thanks, Kieran. Thanks again.
Thanks, fellas. Good luck, everyone.
Thanks, guys.
Cheers. All right. Good night, everyone. Bye-bye.